Back when we started this channel at the start of 2020, one of our first and actually one of our most popular videos was the top Canadian dividend stocks to be looking at moving forward this year. This was before COVID-19 happened, before all of this unfolded. It was business as usual back then, and a lot of investors are emailing us wondering if this list back in January is still relevant today. So in this video, I'm going to do a very quick recap on the 5 stocks we mentioned in that video, as well as bring forward our brand new list of top dividend stocks moving forward post-pandemic. Let's get started. So the 5 stocks we mentioned in our video back in January, which by the way, if you want to watch it, I'll include a link up top and a link down in the description, are TD Bank, Canadian Natural Resources, goeasy Limited, Enbridge, and Algonquin Power and Utilities. And realistically, the only company on that list that has had a significant fundamental change would be Canadian Natural Resources. And even though it has had a significant fundamental change, the company has maintained its dividend. While we've seen other major producers like Suncor and a ton of junior producers cut the dividend. A lot of investors are very weary on goeasy Limited, but it still remains one of the top dividend stocks in the country today. One of the main fears for goeasy is because they lend to higher risk borrowers, there's a higher chance of delinquencies. But the company recently stated that it can still be profitable at over double the rate of delinquencies that it's seeing right now. Enbridge as a pipeline company is going to face some turbulence moving forward, but because the company typically signs 20+ year contracts, take or pay contracts, which means they get paid regardless of product shipped, they have less of a reliance on the price of oil, and in terms of cash flows, they'll be more reliable, and as such, the dividend has less of a chance of getting cut. As for Algonquin, utility companies are in a great position to thrive during this low interest rate environment. The company pays its dividend in US dollars, providing a bonus to Canadians purchasing the company, and its diversification into renewable assets is a huge plus. There hasn't really been much that's changed with Algonquin. We really like the company. And as far as TD Bank goes, I'm going to speak to them way more in depth in this video, so I'm not going to talk about them in this short recap. Out of these 5 stocks I highlighted, the only one I might suggest avoiding right now due to a possible dividend cut in the future depending on the price of oil is Canadian Natural. I'm long the company, I plan to hold the company long term, but investing in the oil and gas sector right now, especially with the uncertainty of a second wave and overall economic uncertainty, I just wouldn't suggest buying these stocks right now. With that being said, let's get into our 3 best dividend stocks moving forward post-COVID. So as I mentioned with Algonquin in the recap, utility companies are in a great position to thrive from this low interest rate environment. The utility business is a very capital intensive sector, which means they have to spend a lot of money to make money. So the cheaper they can borrow that money, the better. If they can borrow money cheaper, they can build infrastructure for cheaper and turn that infrastructure into revenue generating assets for less capital. So for that reason, one of our top dividend stocks in Canada moving forward is Fortis. The stock was trading at all-time highs around the mid $58 range prior to the stock market crash of 2020, and from there the company's stock took a complete nosedive out of pure fear. The company quickly started trading in the low $40 range. And what I mean by trading in this range because of pure fear is the fact that 99% of Fortis's revenues are from regulated utilities. So what is a regulated utility? A regulated utility essentially means that the utility company itself owns the lines, they own the poles, they own the meter boxes, they own the generation method. This essentially eliminates competition. No other utility companies can use that company's poles. Along with this, the company also negotiates with the municipal government at a rate that essentially guarantees profitability while ensuring that consumers are getting the lowest prices possible. This makes cash flows extremely stable and almost immune to competition. The regulated utility market is essentially a legal monopoly. As of right now, Fortis has the second longest dividend growth streak in the country at 46 years. It trails only to a similar utility company in Canadian Utilities, which has raised dividends for 48 years. But Fortis has significantly outperformed Canadian Utilities in terms of both dividend growth and stock returns. Now, we have a lot of investors that ask us, why don't you recommend Canadian Utilities? They pay a 2% higher dividend yield. And it's really important not to get caught up in chasing high yielding companies. In terms of compound annual growth rate, Fortis has outperformed Canadian Utilities significantly. Over the last decade, Canadian Utilities has a compound annual growth rate of around 4.4%, while Fortis is around 6.45%. And this outperformance is amplified even further over the last half decade, where Fortis has grown at a rate of around 7.75%, while Canadian Utilities has actually shrank by more than 1.5%. Over the last 5 years, including dividends, Fortis has actually returned double digits to investors, while Canadian Utilities has barely kept up with inflation. With a market cap of $24 billion, Fortis is the largest utility company in the country, and they operate in the United States, Canada, and the Caribbean, which exposes them to different currencies, different economies, and gives them broader exposure to the utility market. So in terms of dividend, the company yields around 3.63% at the time of me filming this video, and it has a 5-year dividend growth rate of around 7.38%. As I said before, the company has raised dividends for 46 straight years, so the fact that it's been able to raise it at this pace over the last half decade is very impressive. And its dividend makes up only around 32% of operating cash flows, and it has a payout ratio in terms of earnings of just shy of 50%. Keep in mind, this is one of the lowest payout ratios in terms of earnings in the utility sector. The only one that is lower currently is ATCO. Now, in terms of overall returns, Fortis is not going to be a home run, but that isn't the point of holding these stocks. They provide reliable dividends, as you can tell from the 46-year streak, and this is primarily due to very stable cash flows due to the regulated market. What you are going to get with Fortis is one of the best Canadian dividend stocks in the country, one that has outperformed the TSX index over the last decade, and one that has significantly outperformed the index during this COVID-19 crisis. Moving on to our next stock, we're going to talk about a very popular telecommunication company, which is another company that is set to benefit heavily from the low interest rates we're currently getting. Just a quick pause here. If you want more research, more in-detail research, and more dividend stocks, I'm essentially doing this video based off research of our top dividend stock page. I'll put a link in the description and also a link above. You can head there and find more great dividend companies. If you like that list, you can take a look at our other lists, which contain research on over 130 companies at stocktrades.ca, absolutely free. Anyways, let's get started with our second stock. So our second stock is a telecommunication stock. It was actually a very close race between what they call the big three here in Canada, which is our top 3 telecom companies: Rogers, Bell, and Telus. For this video, we actually decided to go with Telus based on some recent information about 5G developments on their end, but also with this being the best of the best in terms of Canadian dividend stocks, Telus does boast the best dividend in the telecom sector. The company has grown dividends for 16 straight years. The next closest in terms of big three is BCE or Bell at 11 years. And Rogers actually decided to not raise their dividend last year, so they currently sit at a 0-year dividend growth streak. There's only one other major company in the telecom sector that didn't raise dividends last year, and this was Shaw Communications. So in terms of dividend, both those companies are kind of behind the 8 ball. Telus has a 5-year dividend growth rate of 8.18% and a dividend yield of nearly 5%. The dividend makes up around 34% of operating cash flows, and its payout ratio currently sits around 15% less than BCE at 83% of earnings. Now, for a long time, Telus was considered one of the worst 5G investments out of the big three. This is primarily because they plan to partner with Huawei, but the company decided to move on from Huawei and partner instead with Ericsson and Nokia. The company is also partnering with Samsung in terms of infrastructure, and Samsung is a proven 5G player as it has developed top-notch infrastructure in Korea, Japan, New Zealand, and the United States. Moving forward, being a more pure play telecom company and not as focused on TV and media opportunities as BCE and Rogers are, we feel Telus is one of the most reliable dividend payers in the country, but also one of the most reliable and safest ways to gain exposure to 5G developments. Now, in terms of valuation on a forward price to earnings basis, Telus is, out of the big three, the most expensive. It's trading at around 18.6 times forward earnings, while BCE sits at just over 18 and Rogers at around 16.61. It's also important to note though that Telus is expected to grow bottom lines or earnings by around 10.5% next year. This is significantly higher bottom line growth than its counterpart BCE. While this is not as high as the 20.5% they expect Rogers to grow its bottom line by next year, this is a top dividend stock video, and Rogers did suspend its dividend growth last year, so we're not exactly big fans of the company right now in terms of income. Another reason I like Telus, and one of the primary reasons I own the stock today instead of other telecom companies, is they don't feel the need to diversify into a media division. These are low return business models, and they instead focus on segments that drive high return on equities like home security, telecom, and even as far as healthcare. Overall, this is a big opportunity for Canadian investors to grab one of the best dividend stocks in the country, one that should be able to utilize lower interest rates to drive growth, especially in its 5G segment, especially with its world-class partners in Ericsson, Nokia, and Samsung, and a stock that's actually trading at 5-year lows. If you're looking at a stock chart that doesn't account for splits, it will look like Telus' share price tanked this year, but it did issue a 2-for-1 split, and that's why it's trading in the mid $23 range right now. Let's move on to our third and final stock, which is one of Canada's top financial institutions. Now, the third and final stock I'm going to talk about, and one that I also own, is TD Bank. Now, there's a lot of controversy around investing in Canadian financial institutions right now. For one, interest rates being as low as they are, and secondly, the inevitability of a recession and possibly a long-term recession, especially in different parts of the country like Alberta. A lot of investors are avoiding these stocks, and I think they're making a big mistake. So TD Bank has arguably the highest exposure south of the border in the United States, and this does a few things. This should expose them to a stronger US economy, even if ours lags in recovery, and secondly, exposes them to a stronger US dollar. TD Bank was actually named the most convenient bank in the United States and currently has over 2,400 locations. Now, investors were quick to look at TD's second quarter results, which saw net income slashed in half. One of the primary reasons of this drop in net income is loan loss provisions. The company had to set aside $3.2 billion in loan loss provisions. This is compared to around $920 million during the first quarter. Now, if you don't know what a loan loss provision is, it's essentially an allowance that the bank has to set aside for loans that it predicts might go unpaid. So this $3.2 billion is cash that they still have. They just have to set it aside in the event that the loans don't get paid. Now, these are just that, provisions. Not all of the loans that they predict could go unpaid will go unpaid. So you could see some of this capital from their loan loss provisions returned back into the net income. This is why TD Bank's income fell so drastically in the first quarter. And there is the potential that loan loss provisions could increase even more in the second quarter, as the company will be providing full COVID-19 reports in the second quarter. Now, this COVID-19 pandemic to most would seem disastrous for the Canadian financial institutions. And I'm not going to lie, it's not going to be good. But the fact is, Canada holds some of the strongest financial institutions in terms of capitalization, regulations, and stress tests in the world. And most of the institutions in Canada should be able to survive this. Now, major Canadian banks have been told to hold off on dividend increases, but they can still continue to pay dividends. And this is much like the 2008 financial crisis, where all 5 of the big banks maintained their dividend, while financial institutions around the world were slashing them at a rapid pace. Another argument by investors with a negative outlook on Canada's financial institutions is the fact that mortgage deferrals are being used at an extensive pace right now. But the fact remains, these banks are still charging interest on these mortgages. Mortgage deferrals are ultimately a game changer for people who need them right now, but over the long run, it will cost them a significant amount of money in terms of interest paid. In terms of dividend numbers, TD Bank has the best dividend out of the big five. They currently have a yield of around 5.11% and have raised dividends for around 9 years. They have the highest 5-year annual dividend growth rate out of all of the big five banks at 9.45%, and they also have the lowest payout ratio of any of the big five banks at around 52.81%. So that's pretty much it for the video. Out of the 7 stocks, the ones in January and the ones now, let us know in the comments which ones you like, which ones you don't like, what dividend stocks you're looking at right now. Do you prefer high yield or do you prefer strong dividend growth stocks? And also, most importantly, like the video, subscribe to the channel for more great Canadian exclusive investment content. Till next time.